Imagine it's the late 1990s. The internet is revolutionizing the world, and the stock market is buzzing with excitement. People are cashing out retirement funds, maxing out credit cards, and even taking second mortgages to invest in tech stocks. Headlines proclaim a new era of prosperity. Tech stocks are the future. Invest now or regret later. You decided to take advantage of this opportunity and take your first steps toward investing. Let's say you invested $10,000 into the stock market in August 2000. You invested all at once, with no option for further contributions, knowing that the price is going up without significant kickbacks. But then, it all comes crashing down. The dot-com bubble bursts, wiping out over $5 trillion in market value by 2002. Companies that seemed unstoppable like Pets.com disappear almost overnight, leaving millions of investors in shock and financial ruin. Thus, it would take you about 7 years just to break even on your investment, and about 13 years to earn your first income due to the financial crisis of 2008. The number of years would even increase if we adjusted this amount for inflation. It would then take about 15 years just to break even. However, there is a way to turn this chaos into an opportunity by making regular contributions. This strategy is called dollar cost averaging, or DCA, which can transform uncertainty into a systematic advantage. In this video, we'll explore how DCA works, why it's so effective during volatile times like the dot-com crash, and how it can help you build wealth steadily, no matter what the market throws at you. Dollar cost averaging is a fancy name for investing a fixed amount of money at regular intervals, regardless of what the market is doing. Think of it like buying groceries every week. Sometimes things are on sale, and other times they're a bit pricier. But over time, the cost averages out. Let's look at two friends, Sarah and Mike. They both have $12,000 saved up for investments. In January 2008, Sarah invests all at once in S&P 500. It is also called lump sum investing. Mike, on the other hand, decides to spread his investment evenly over the next 12 months, using the DCA strategy. When the market crashed in late 2008, Sarah's portfolio took a massive hit, while Mike kept buying during the downturn, snapping up shares at bargain prices. 2 years later, Sarah's investment portfolio is worth about $10,000, while Mike's portfolio had already fully recovered to initial $12,000. The reason is that he averaged out his cost and benefited from buying low. However, when market is upward trending, the lump sum strategy can outperform the DCA. A study by Vanguard found that in 68% of historical periods, a lump sum investment in a diversified portfolio yielded higher returns than DCA. But here's the catch. Lump sum investing works best when you have a large amount of cash and can stomach the risk of short-term market fluctuations. Also, there is no guarantee that you won't invest right before the stock market crash or recession. Then you will see your portfolio with negative returns for a longer time period. Dollar cost averaging isn't the only strategy out there for systematic investing. Another approach is called value averaging, or VA. While DCA focuses on investing a fixed amount at regular intervals, value averaging involves adjusting your contributions based on market performance to reach a target portfolio value over time. If the market is down, you invest more to hit your target. If the market is up, you invest less. This approach forces you to buy more when prices are low and less when prices are high, amplifying your gains during recoveries. The decision on which strategy to choose depends on your goals and discipline. Theoretically, value averaging can yield higher returns than DCA, but it requires flexibility and active management of investments, monitoring the market and adjusting the strategy. It is also harder to automate, which could lead to missed contributions or errors. Dollar cost averaging, on the other hand, is simpler, easier to automate, and better for investors who want a hands-off approach. Ultimately, saving cash without investing is often the worst strategy because inflation eats away at your purchasing power over time. So any strategy you choose is better than inaction. Research from Morningstar shows that during the period from 2013 and 2022, the average annual investor's returns are far lower than market averages. Another research from Winthrop Wealth compares average annualized returns of stocks, bonds, 50 by 50 portfolio, and average investor from 2001 and 2020. It is clearly seen that portfolio performance of average investor is lower than other asset classes and slightly higher than inflation. The conclusion of both studies is that the main drivers of poor investor returns are emotional decision-making, incorrect asset allocation, and market timing. Dollar cost averaging helps remove these factors from the equation, providing you with the average market return. Now, let's talk about when DCA might not be the best choice. Imagine you inherited $100,000. If the market is on an upward trend, putting that money to work immediately might yield better returns than spreading it over several years. Also, remember that DCA doesn't guarantee profits or protect against losses in declining markets. However, if you're worried about volatility, DCA can provide peace of mind. If you're ready to start your DCA investing journey, here's what you need to do. Decide how much you can afford to invest regularly. Choose your investments, whether it's an index fund, ETF, or individual stock. Finally, automate your contributions. Most brokerage accounts and apps allow you to set up automatic investing. And remember, consistency is key. Even during market downturns, stick to your plan. That's where the magic happens. Set realistic goals, review your portfolio quarterly or annually, and stay informed about the investments you've chosen. If you found this video helpful, hit the like button and subscribe for more tips on investing and personal finance. Let us know in the comments if you're already using DCA or thinking about starting. See you in the next video.